Hello, Santosh sir. How are you? Am I audible to you?
You're audible. Am I audible?
Yeah, audible.
Good.
So we'll just start the session in another 2 to 3 minutes.
Problem. I'll set up the PowerPoint in the meanwhile.
Please do. So we can start the session. I welcome our CA D Santosh sir. He's an expert speaker in the securities and finance, and he's having a vast experience in the field of valuation and finance, being a CA from the field of chartered accountancy. And today's topic is 1 hour session on valuers practice value in capital gain and other sources of income tax, and I'm sure everybody is going to enjoy the session. Over to you, Santosh sir.
Thank you so much from the administration of AARVF. So let me quickly try to share the screen. Let me know whether it is visible, and then I think we go from there. Is the screen visible?
Yeah, it is visible. It is it is visible now.
Thank you so much. So hello everyone. Thank you for joining with us today on a Saturday evening. Thank you AARVF for inviting me and keeping the session somewhere after 4 o'clock, so that it will be better to concentrate and it's easier to assimilate. So today our session, we are going to, I hope that you have seen the name of the session. It would have been capital gains and other sources in income tax, and how valuers play a role in getting the valuation done under Income Tax Act. Let's quickly run through. There are a lot of concepts that are there. Wherever there is an area which concentrates more on income tax, I tend to little bit go a little fast, because we have only 1 hour. A little fast in the income tax areas. But wherever it is concerned with valuation, I would stop, and let's keep it 45 minutes of me talking and 15 minutes of discussion. So I'll keep the last 15 minutes for the discussion. 4:45 to 5, we'll have a discussion. Now, moving on, first thing that we're going to handle would be the capital gains. Most of the chartered accountants here, registered valuer who have qualified as a CMA, CES, you would have an understanding of capital gain, good understanding. MBAs and other people, you would have a fair understanding of capital gains, but then this would be a refresher. Now, first, when does capital gain arise under Income Tax Act? There are three things that needs to play out for taxing a capital gain. Number one, first there should be a capital asset. Then there should be transfer of that capital asset, and because of this transfer, there is a resultant profit or gain that the assessee has benefited from. Now, these three things I'm going to explain a little in detail. What is a capital asset? Any kind of asset which is held as a property of the assessee, which is not connected with the business or profession of the assessee, would become a capital asset of that assessee. So if I have a land, I'm a real estate, I run a real estate business and I have land as stock in trade, that is not my capital asset. It's the business's asset. But if I'm not running a business of real estate, I am an individual who has either salaried income or I run any other business and I have this particular capital land as an asset, as an investment. I have invested on a plot in the suburbs of the city, and that asset I'm trying to sell. That particular asset would form part of my capital asset. And apart from that, any securities that are held by FIIs, they are also brought into the ambit of capital asset. Earlier there was a confusion that has been plugged in and it has been brought into the ambit of capital assets. So when I told you, I gave you a very broad definition. Everything and anything which is not related to business, it becomes a capital asset. There are some exclusions to it. A few exclusions are given here. Stock in trade, which again goes back to your business. You hold something, some asset as stock in trade, that again goes out. It's not a capital asset. If you trade in it, probably you'll have business income and it will be taxed under the head PGBP, but not under capital gains. There are specified gold bonds and special bearer bonds issued by the government time and again. These assets are not considered as capital assets. So though you have invested only for the purpose of investment in these bonds and securities, when you sell it, they are not capital assets. It's not taxed under capital gains. Then rural agricultural land, there is a big definition for it. Next slide, I'll give a broad explanation. If you have an agricultural land which is not located in an urban area, but in a rural area, that is not taxed. Gold deposit certificates, again, this is with banks and the government has come out with gold deposit certificates. That is not defined as a capital asset. So that's an exclusion. And personal effects are not taxed. So example, there are certain assets. So I buy for my personal purpose, I have bought an AC or I have bought my mobile phone. If I sell the mobile phone for whatever reason I'm trying to sell it for a profit. I buy it for 10,000. It usually doesn't happen. Depreciation happens. I sell it only for 5,000. But then if I buy a phone for 10,000, for whatever reason somebody buys it from me for 15,000 or 12,000, the capital gain doesn't arise out of this personal effects. Whatever is there, it doesn't arise there. The possibility is low, but then if it arises, it's not taxed. Now, when we move on to rural agricultural land, there is a big definition that is there. I'll share the PowerPoint presentation with you. Take a look at it. If in case there is an agricultural land which you come across, which falls under these areas, then it automatically is not taxed because it's a rural agricultural land. Stay with me. Initially, it will be a little slow because I'm going into the law. Then at one point in time, I'll connect you all back with the valuation area where interesting things will unfold. Now, personal assets, there are certain exclusion to the exclusions. When I said personal assets, it's not taxed, it's not considered as capital assets, but certain personal assets are again considered as capital assets. Jewelry, archaeological collections, drawings, paintings, sculptures, and any work of art, they will be considered as a personal asset, which will not be considered as a personal asset. So it will be treated as a capital asset and it will be taxed. So capital asset in exclusions, which is not a capital asset, they have set personal effects. But then under personal effects, again, there is an exclusion where these assets, jewelry, etc., would be treated as it's an exclusion to the personal asset. Therefore, it will become a capital asset. So these items, if you have, you will be taxed when you sell it. If you make a profit, it will be taxed. Then what is a transfer? Transfer, there is a proper definition that is given. If there is a sale or extinguishment or relinquishment of the asset, if there is an extinguishment of any rights in relation to the capital asset, or there is a compulsory acquisition by the government, conversion of capital asset into stock and trade. You have a land which you have invested as you have had it as an investment, but then you opened up a real estate company and you have a real estate business and you have transferred that into that business as a stock and trade. That will be amounting to transfer. Maturity and redemption of zero coupon bonds, allowing possession of immovable properties, all these would become part of your transfer. So not only sale, you have a property and you are giving a power of attorney where you are ceding some rights to that particular person for a consideration, then that will also be considered as transfer in most of the cases. So that is something that you have to keep in mind. Now, what is not transfer? There is a huge list that is there. I'm going to share it with you. You can take a look at it. Distribution of capital asset on total or partition of an HUF. It is not considered as a transfer. It was an HUF. It is already belonging to the Hindu undivided family members only. But then when you partition it, it reaches you. It doesn't amount to transfer. Distribution of assets in any kind by a company to its shareholders at the time of liquidation. It already, the asset has been bought out of tax paid funds of the company. When it is being distributed to the shareholders, again, it will not be taxed. Like this, there are about 20 to 30 cases that are given. All these cases, it will not be a transfer. I'll share it with you. You can take a look at it. 42 cases are there. Now, this is all refresher minded. Long term versus short term. What is long term? What is short term? When an asset is being sold, the time period for which you have held the asset. So, how long did you hold that asset for? If you've been holding the asset for more than X number of months, then it will be considered as long term. And if you're holding it for lesser than that, it will be considered as a short term. So, why is the difference between long term and short term? Short term capital asset, short term capital gains will be taxed at a different rate. Long term capital gains will be taxed at a different rate. There are certain exemptions, there are certain deductions, there are certain benefits like indexation that are given when you have an LTCG, long-term capital gain. When it comes to short-term capital gain, those benefits do not apply. So that is something you'll have to keep it in mind. So how do you calculate? What is the number of months that is mentioned here? In case of listed securities, units of UTI, Unit Trust of India, units of EOF and zero coupon bonds, it is 12 months. Anything you hold more than 12 months, it becomes a long-term capital asset for you, capital gains for you, capital asset for you. 24 months for unlisted shares and immovable properties. You buy a private company's shares and you hold it for more than 24 months, it becomes a long-term capital asset for you. And immovable properties, any immovable properties, again 24 months. Any other capital asset not falling within the categories explained as 12 to 24 will take 36 months for it to become long-term capital asset. Now, depreciable assets is a different category altogether. When it comes to depreciable assets, any business-related assets that you have, it will get into depreciation. And depreciable assets, the capital gain calculation is a little different. Capital gain arising on transfer or business is considered as a short-term capital gain only. There is no long-term because you have been using it for your business. Short-term capital gain or loss from sale of depreciable assets will arise only on the following two situations. Not every transfer of depreciable asset will entail a capital gain. It will occur only in two situations: when on the last day of the previous year, the WDV block of the asset is nil, and on the last date of the previous year, the block ceases to exist. So when it comes to business-related assets, which is depreciable assets being sold, you have a block. There's a concept of block in the income tax depreciation calculation, where all assets which are of similar category are put into one block. So if you have 10 cars, all 10 cars will come under one block. When you go on to sell one of the cars, unless otherwise there is no asset in the block, or there is the value of that particular block has become zero, there is no capital gain or loss that will arise out of this transaction. So if there are 10 cars, each car for 1 crore, you bought 10 crores is the total value. 1 year passed by, the depreciated value is 9 crores of that block. If you sell this particular car for, say, 1 crore, or let us say you sold it for 2 crores also, whatever you bought for 1 crore, you sold it for 2 crores. Still, though it seems as if there is a capital gain that is there, since the block has 9 crores balance, it is not treated as a long-term capital gain. It will be adjusted against the block's value. Now, computation, very simple and straightforward. For short-term capital gains, whatever is the value that you get for transfer of this particular asset will be treated as the full value of consideration. Any cost of acquisition that you had for the purpose of acquiring this particular asset, you can reduce that. Any improvement cost you have spent from the date of you purchasing that property till the date of you selling, including any brokerages, etc., that you can consider it as part of cost of improvement. In fact, when it comes to sales commission that you pay on the sale transaction, you can reduce it directly from the full value of consideration itself. And then expenditures incurred wholly and exclusively in connection with such transfer, again, that you can reduce. This again includes the transfer documentation value, the stamp duty value, all registration value, all this you can reduce. and whatever is the remaining that you arrive would be the short-term capital gain. In the case of long-term capital gain, there is a small change where you are allowed to take indexed cost of acquisition and indexed cost of improvement rather than taking just cost of acquisition. So you bought something for 1 lakh, you're selling it for say 2 lakhs. Between the time between which you have held that particular asset, say 5 years, the inflation has been a silent factor that has been brought into. Whatever you bought for 1 lakh rupees today in the market itself, it would have been valued at 2 lakhs. Therefore, what computation the income tax recommends is that go back to the CII, where the cost inflation index, which is published by the income tax department, go back there, refer to it, and find out what was the inflation index on the date of you purchasing it versus what is the inflation index today. This is only applicable in the case of long term. So you held something for 5 years. Obviously, it is long term. You go back to what is the value of index value on that particular date, 2019 or 18, and today in 2023, whatever is the value that you find, you divide it by the value that was there previously, and you multiply it with the value that you have now. You will arrive at the indexed value of that particular asset. Same thing, you can do it for cost of improvement also. Finally, expenditure wholly and exclusively in connection with such transfer, it will be done not on index basis. Why? Because it happens today. You're transferring the asset today, and it doesn't have any indexation benefit because it is happening today. Therefore, that is the long-term capital assets. When it comes to depreciable assets, it is a little interesting. You don't start with full value of consideration. You don't start with the cost of acquisition, but you rather start with the WDV of the block of asset at the beginning of the previous year. You take WDV of the block of asset at the beginning of the previous year, add the actual costs of assets falling within that block acquired during the year, and then you reduce the full value of consideration of assets transferred during the year. If there is a negative value, then it means that you have a capital gain and you'll have to pay taxes for it. If there is no negative value, if there is a positive value, then depreciable asset, it is not taxable. Whatever is the carry forward WDV, you keep carrying forward. So in our case, 10 crore worth of car you bought a couple of years ago, 1 or 2 years ago. Currently the block's value is 9 crores. You still have all the 10 cars. One car you're trying to sell it for say 2 crores. 9 crore minus 2 crore, you will arrive at 7 crores. The 7 crores is the value of that particular WDV you will carry forward. But let us say in the case of, instead of in the 9 crores, let us say somebody is ready to buy one car for, let us say 10 crores or 11 crores. That particular person buys one car for 11 crores. Out of this 9 crores, you can reduce the 11 crores, and the negative 2 crores that you get, that would be treated as the capital gain, and it will be charged under income tax. So entire block is closed now, and you will be having a 2 crores of capital gains, long-term capital gains that you will have. Short-term capital gains you will have, which you will have to pay taxes for it. What happens to the WDV? WDV is closed. Going forward, any car that you sell, automatically the block value is 0. Therefore, you'll have to pay tax for it. Now, cost of acquisition. What can be the cost of acquisition? This is where, so far, whatever we have been talking about has been only income tax related matter. This is where you have the important point coming up. Cost of acquisition, if the asset became property of the taxpayer after April 1, 2001 by way of gift, will, etc., in mode specified in 49 subsection 1, the cost of acquisition of the previous owner can be taken. So, if the asset became the property of the taxpayer after 1st April 2001, but so you can so essentially, I will draw a line on 2001. If something has become my property after 2001, whatever is the actual value that I can take, and I can go on to do an indexation. If the asset has become the property of the taxpayer after, so I'll first explain this, then probably we'll go there. I should have taken it the other way around. If the asset became the property of the taxpayer after 1st April 2001, no problem. You take the cost of acquisition as that value. But if the property became the property has become the taxpayer's property before 1st April 2001, since the cost inflation index has been published only from 1st April 2001, there is a requirement under Income Tax Act to go on to find out what is the fair market value as on 1st April 2001 and take on that value and do the indexation. So I bought a property for 1 lakh in 2002. When I have to find out the indexed value, I take only 2 lakhs or 1 lakh, which is the 2002's value. If I bought the same property for another property for 1 lakh, say in 1999, which is before 2001, for 1 lakh rupees, Can I take that 1 lakh and arrive at the indexed value? No, because the published value is only as on 2001. Therefore, what I can do is I can go on to find out what is the fair market value as on 2001 for that property, and then I can calculate the fair value of the, calculate the indexed cost of acquisition, which will help me calculate in the calculation of capital gains. Now, where is the opportunity for registered helpers? The calculation of fair market value does not require any professional as per Income Tax Act. Only one person authorized by the Income Tax Act to do the fair market value calculation would be an income tax valuer. He is a departmental officer, valuation officer, who is who has the responsibility, who has the authority to do the valuation. But that being said, what can be done is the assessee sometimes, to satisfy the assessing officer's request, before before filing of his return, he takes the help of a registered valuer. And the registered valuer's report, he can take it to the assessing officer, because the assessing officer does not have the mandate to go back to the valuation officer. If he is satisfied that that particular area's value that you have taken as the fair market value as of 2001, if you satisfy him, then he doesn't have to refer it to a valuation officer. If the assessee takes a registered valuer's report, that it should be more than enough for taking it forward with the income tax department. So, in this context, we have the opportunity to issue fair market value reports by registered valuers, because today, as it stands, only registered valuers report is being respected even in the income tax circles. There is another registered valuer under income tax itself, which borrows the concept of registered valuer from Wealth Tax Act. But still, registered valuers under Companies Act also can issue a report, because there is no binding status. But still, there is a probable reason for the assessing officer to take on the report and accept and move forward. One small input that I would want to give here is, in the case of cost of acquisition, when there is a property that is bought by, say, my grandfather, and the grandfather's property he has transferred by way of gift to me, and after a point in time, somewhere in between, he has passed away and he has transferred the property through will or something, it has reached me, and I try to sell the property today. Should I take the value as 0, or should I take the value of as the value at which my grandfather took it? I can take the value at which my grandfather has taken that valuation. Bought that particular asset. Now, if he has bought it after 2001, as usual, there is no fair market value calculation. I'll take the value directly. But if he has bought it before 2001, I'll have to go on to find out what is the fair market value as on today. So that is something that we'll keep it in mind. So that is one area of practice for registered valuers. In relation to goodwill of a business, so this is cost of improvement. Cost of improvement, there are multiple items that are there. What we can do is, again, in cost of improvement cases, lot of cases, all the improvement records will not be available with the owner at the time of selling. So he would have done a compound wall construction, and he would have constructed a swimming pool in a small area. After he has bought it, he would have constructed a swimming pool. All these small expenses that he has made, in most cases, the assessee is not going to have a record in his hand. Without any records, the officer will not be able to help it. He will not be able to allow these expenses as cost of improvement. Again, in these cases, a registered valuer's report, where he goes on to take a look at all the improvements that has been made, he can prepare a report. He can give it as a documentation, so that it can be substantiated with the assessing officer that these expenses has been made. Again, this is not binding on the officer, but at least it will serve as a remedy in case you don't have any bills, etc. Okay, so at least I will know. Right. Now, indexation, this is the calculation. You have cost of acquisition, you multiply with the CII of the year of transfer, and you divide it with the CII of the year of acquisition. In case if it is before that, you can go on to use the CII for 2001, 2002. If you have bought it before that, if in case you are not able to find the fair market value, if they are not ready to take the report at all, then you go on to take the previous year's value, but then you'll have to take 2001, 2002 CII only. So examples here, rates of taxation. In the case of short-term capital gains, it shall be included in the gross total income of the taxpayer and will be taxed at the normal rates. So the slab rates will automatically apply. In the case of short-term capital gains arising from equity shares, units of equity-oriented funds, and units of business trust, these are charged under 15% under 111A. Now, benefit of reduced tax of 15% shall be available with effect from 1/4/2016 only, even in respect of income arising from transfer of units of business trust which were acquired by the SC in lieu of special purpose vehicles. Now, when it comes to long-term capital gains, the tax rate is 10% or 20%. Usually, it is 20%. Long-term capital gain arising out of transfer of listed securities, it is usually 20%, but when it is listed, when it is not arising from, okay, this is long-term capital gains arising from transfer of listed securities, units, or zero coupon bonds shall be taxable at the lower of the following. So this is other than long-term capital gains arising from other than transfer of listed securities, units, or zero coupon bonds. It will be taxed at 20% in the case of benefit when you take the benefit of indexation, 10% when you 20% when you take benefit of indexation, and 10% when you don't take the benefit of indexation. Now, one thing that you'll have to keep in mind, when it comes to listed securities and all, automatically you go under the normal this thing. Long-term capital gains arising on non-residents or foreign company from transfer of unlisted shares, you'll have to there shall be taxed at without giving the benefit of indexation. If you're calculating the capital gains for a non-resident, you will not be allowed to take the benefit of indexation. Okay, this is where the valuation officer comes into play. With a view to ascertain the fair market value of a capital asset, the concerned assessing officer may refer the valuation of the capital asset to a valuation officer. The important operating word is may. As long as you are able to substantiate to the assessing officer through a valuation report from a registered valuer stating that this is the fair market value as on 2001, he has no mandate to transfer it to a valuation officer. In case if the report is not articulated, then probably he may refer it to a valuation officer. Then again, valuation officer, he has his own way of finding out the value. Then the registered valuer's report is not going to be of any use. Probably he may again refer it back and find out some corrections to it, and he might give a valuation report. But again, there is no binding nature there. Where the value of the asset is as claimed by the assessee is in accordance with the estimate made by the registered valuer who works for a private capacity under a license issued by board, or his valuation is not binding on the AO, but the AO is of the opinion that the value so claimed is at variance, then he might refer it to the valuation officer. Now, moving on, there are other areas. So capital gains, pretty much 20 minutes we have covered. We'll move on to the other sources where again valuation is required. What is other sources income? There are 5 different categories here. One would be your dividends, any investments that you've made and the dividends that you receive from it, that would be taxed under other sources. Any interest that you earn from your banks, fixed deposits, bonds, and even if private finance, that comes under other sources income. Any rental of plant and machinery, other sources income. Gifts and compensations that you have received, which does not fall under any of the previous category. So if an employer gives any gifts to his employee, that will be charged under salary. Perquisite or non-monetary benefit, they come under salary. But if it doesn't come under salary, if there is no connection between the two people, then it comes under other sources. And then there is the miscellaneous category. Now, I will get on to only gifts, where that is where the valuation come into play. Because in other cases, valuation does not come. Dividends, interest, plant and machinery rentals, and miscellaneous, there is no effect of valuation. But valuation will come into play only in the main area, which is gift. Earlier, when the gift was started to get taxed in somewhere around 2004 onwards, the income tax department envisaged only the cash that is being transferred. Any sum of money which you have received in excess of 25,000, that will be taxed. That was the only thing that was there. 56 subsection 2 clause 5. Then the department slowly understood that 25,000 was not a very reasonable amount. They increased it to 50,000. So below 50,000, it's not a problem. Above 50,000, it was a problem between 2006 to 2009. But 2009 onwards, the department understood that individuals or HUF don't necessarily have to transfer cash, but rather they can transfer in the form of property. So 5 different property categories were brought into this ambit, where you have transferred it without consideration or without adequate consideration. So something is worth 1 lakh rupees. If you have transferred it for say 10,000 rupees, that will come under the ambit of gift tax. Now, firms or closely held companies, if there is an issue made by that particular company, and if that does not follow the valuation guidance, then because to sidestep this process, companies were incorporated and shares were issued at a lower price, and the assets were being transferred. The ownership was being transferred to the ultimate shareholder. That loop was closed through 56 subsection 2 clause 7A. After this, 56 subsection 2 clause 10 came into play, where everything was plugged in as one shot. And after 2017 onwards, clause 10 only operates. Now, when you look at clause 10, 56 subsection 2 clause 10, gift tax, 3 asset categories can be demarcated. Any sum exceeding 50,000 rupees, that will be taxed in the hands of the receiver if you would not received it without consideration. Any immovable property, if the transfer value exceeds 50,000, what is that value? It's a stamp duty value. So I have a property whose stamp duty value exceeds 50,000 and I have transferred it to somebody. The person who receives that particular property, he will be suffering tax. It can be without consideration. It can be without adequate consideration also. What happens to without adequate consideration? In the case of without adequate consideration, I have transferred a property worth say 1 crore for a measly amount of 10 lakhs. He has paid me an amount, but the stamp duty value is worth 1 crore, but I have gotten paid only 10 lakhs. So this 90 lakhs will be taxed in the hands of the receiver of that particular property. Now, in the case of immovable property, it is the stamp duty value, but when it comes to any other property, it is the fair market value. I have an artistic painting of say M.F. Hussain, and I am trying to sell it. Its worth is exceeding 50,000 rupees. Let us say again, it is worth 1 crore rupees. If I transfer it to the person without consideration, it will be taxed. If I transfer it for lesser consideration also, it will be taxed. Now comes the concept of fair market value. So in the case of sum of money, you don't need any valuation. In the case of immovable property, straightforward, look at the stamp duty value. But in case of any other asset, fair market value comes into play. This is where we'll have to take a look at it. 50 CA, I'll sidestep for now because it is income tax related. I'll come back here. Now I'll go into the main concept. Who can value the particular assets? Cash no valuation, immovable property. As we have already discussed, a registered valuer can issue a report if it is 2001 or before, but otherwise it is the AO can refer it to the valuation officer. In the case of any other property, then you can go on to 11 UA. You'll have to go on to 11 UA, where only 3 persons are authorized to do the valuation. One is a chartered accountant, the other is a merchant banker, the other one is a registered valuer, but it's an income tax registered valuer. Now, when it comes to jewelry, it is pretty straightforward. It can be, if it is being bought from a GST registered person, then there is no requirement for valuation. If it is charged with GST from a registered dealer, when I say registered dealer, GST registered dealer, then automatically it is accepted fair market value. But if it is bought from any other person, then you can go on to and the amount exceeds 50,000, you should go on to a registered valuer under Income Tax Act. He will be doing the valuation for you. Then when it comes to artistic work, again, if you are purchasing it from the registered person, there are registered organizations, GST registered organizations, which make trade in these kinds of artistic work. You are safe, and that will be whatever value that you bought it for, it will be considered as the fair market value. But the moment you buy it from any other person and the value exceeds 50,000, go to the income tax registered valuer, get a report which says that this is the reason why this and these are the reasons, these are the inputs, and so and so is the value. This is the fair market value as per Income Tax Act. That will be accepted. Otherwise, it will be referred back to the assessing officer. He might have to take a help of another valuer to get it assessed. In the case of valuation of securities, in the case of quoted securities, it is not a problem. Straightforward, you go to the index itself, where you go on to NSE, or sorry, not the index, you go on to the stock exchange. The stock exchange, whatever is the price at which it was trading on that particular date, you take it. If you don't have a trade on that particular date, you go on to the previous date. And there are methodologies that are prescribed where you go on to calculate, which is straightforward, nothing to do with valuation. But when it comes to unquoted equity shares, 11 UA, clause C, subclause B, you go on and do a valuation under NAV method. The methodology is prescribed here. There is no requirement for any certification per se as per the norms, but as per the act, but as per the norms, usually they get it certified from a chartered accountant. The calculation is being certified by a chartered accountant. I'm going to skip the entire procedure of how to do the valuation. It's a straightforward NAV method where you reduce assets minus liabilities. Assets minus liabilities, you get the NAV divided by the number of shares. You will arrive at the per share value. When it comes to unquoted equity shares, unquoted non-equity shares, so when you value CCPS, NCPS, all these preference shares and other non-quoted, non-equity securities, then you go on to get a valuation report from a merchant banker or an accountant. So a chartered accountant can also do the valuation, or a merchant banker also can do the valuation. Now, what happens in the case of 56 subsection 2 clause 7b? This is again a tax on cases where the assessee is trying to sidestep the law using innovative methods. So I want to transfer some asset to somebody. I am not able to directly transfer. So I incorporate a company, transfer all my assets as a capital contribution into that particular company, and then I sell the shares of that company to another person. Or I don't sell the share. I only have, let us say, 100 shares in that particular company. Total shares is only 100 shares. But if I transfer shares, 56 subsection 2 clause 10 comes. Therefore, what I do is I go on and issue shares from this particular company. Though I have 100 shares, I issue 10,000 shares to the other party at a very measly price. So the entire value of this particular company is now worth, say, 1 crore rupees. 100 shares, it is 10,000 rupees per share, or 1 lakh rupees per share. But then I issue the shares of that particular company to the other person. 10,000 shares I am issuing at 10 rupees. This process was being followed in between to sidestep the process of to sidestep paying taxes on gift. To stop that, 56 subsection 2 clause 7b came, wherein if the assessee, who is a company which is not a substantially public interested company, so you are not a listed entity, you go on to issue shares to a resident or a non-resident. Earlier it used to be only a resident. If you issue it to a non-resident, there was no problem. Now, resident or non-resident, has been an amendment for both parties. If you have issued shares for a value which is lesser than the fair market value, then you will be taxed. Now, it does not apply to certain category of people. If you have registered yourself as a startup and your investments come through a venture capitalist, then you don't have to get into this angel taxation. That used to be the case. Now, this is an in respect of a company which is exempted under 56 subsection 2 clause 7b rigors and subsequently fails to fulfill the conditions. So I have to satisfy X, Y, Z condition to be a startup, where I have initially accepted those conditions and I have moved on to get the registration, and then I have used the 56 subsection 2 clause 7b exemption to not pay angel tax. But then later one of the conditions is violated. Therefore, my startup status goes off. Then on the date of violation, the previous transaction will be taken up for question, and it has to be treated as a misreporting of income with the tax along with penalty has to be paid there. So this is something that you'll have to keep in mind. Next, what happens? There is two summaries that I want to talk about. This is the crux of the matter. The issue of shares. If you are issuing a share at above the fair market value to a startup, then there is it is exempt. There is no tax. When you issue it to a non-startup, the difference between the fair market value as determined under 56 rule 11 UA sub rule 2 and the value at which you have actually issued the shares, will be taxed in the hands of the company. Will be taxed in the hands of the company. In the case of below fair market value, since it's an anti-avoidance kind of law, be it a startup or non-startup, it is exempt. There is no tax at all. If it is below the fair market value, there is no problem. Earlier, the issue of shares to non-resident was not covered. Now, issue of shares to non-resident is also covered. Now, in this context, I would want to take you back to one particular slide I skipped, but I think it is necessary for. In the case of 56 subsection 2, clause 10, we talked about clause 7b. In the case of clause 10, above fair market value, if there has been a transfer, and if the buyer, in the case of the buyer, if you have transferred it above fair market value, there is no problem at all. Something which is land worth 1 lakh rupees, I have actually sold it. I have actually transferred it for more than the fair value. Though it is 1 lakh, I transferred it for 2 lakhs. The government does not have a problem because I'm paying tax. Buyer also has no problem. Seller also has no problem. But as particular land which is worth 1 crore rupees, I'm trying to sell it for say 15 lakhs or 20 lakhs. 56 subsection 2 clause 10 applies to the buyer. Whoever has bought the asset, in his hands, 1 crore minus 15 lakhs, 85 lakhs will be taxed under 56 subsection 2 clause 10, 30% tax he has to pay. Next, it comes to the seller also. This is the case of double taxation, but it is an anti-avoidance kind of law, so it is mandated there, where though I have stated in my revenue that I have only received 15 lakhs, I will be taxed as if I have received 1 crore, which is the particular slide I skipped for you, 50 CA, where the net value of consideration will be taken as the fair market value, which I have tried to avoid. I would have bought it for 1 lakh. I am trying to sell it for 1 crore. Though I am transferring it only for 15 lakhs, my value will be taken as 1 crore minus 1 lakh, 99 lakhs I'll have to pay tax from my pocket. This which will overlap with the 85 lakhs tax that the other part tax for 85 lakhs, which the other party, the buyer, is going to pay. So twice it will get taxed, which is something we'll have to keep in mind before we try to structure an agreement in this kind of transactions. I'm going to skip everything here. I'm going to take you to the 11 UA subrule 2. Again, 11 UA subrule 2 is almost a copy of 11 UA subrule 1, where you go on to calculate the net assets value. Assets minus liabilities, you arrive at the net assets value. You divide it by the number of shares that particular company has. Whatever is the value, resultant value that you receive, that would be the value of the per share. One share, what is the value you will arrive at. This is applicable in case of unquoted equity shares. When you go to clause B, that clause B applies for unquoted non-equity shares. Okay. This needs to be unquoted non-equity shares. The fair market value of the unquoted, okay, this is again unquoted equity shares only. In the case of unquoted equity shares, you can either take that value or you can go on to get a discounted cash flow method valuation done from a merchant banker. Earlier, it used to have the chartered accountants also to do the valuation. Now, chartered accountants are removed. Only a merchant banker can do a valuation, and only one methodology is prescribed, which is discounted cash free. There is no other methodology that you can use. You can have multiple methods. It was not used earlier. Now there is an amendment again. I'm going to open that for you, where they are allowing 5 different methodologies to do valuation. Now, couple of things that we'll have to keep in mind. Balance sheet. Whenever they say you can use NAV method, you take the balance sheet and you calculate the NAV. The balance sheet they refer to is the audited balance sheet of that particular company. Next, when they say balance sheet, okay, we'll skip that. Quoted equity shares in relation to shares or securities means the share or security is quoted on a recognized stock exchange, predominantly National Stock Exchange and the Bombay Stock Exchange. If there is any other recognized stock exchange, you can go on to take it as per the SCRA law. There is a recognized stock exchange, you can take that. Defined professionals, registered dealer. Erstwhile CST Act was being used. Now GST. This is not general sales tax laws is the common terminology that is being used. Now GST, goods and service tax, whatever registration that is applicable, if the particular party has taken that registration, then you are considered as a registered dealer. Who is a registered valuer? You might have to go to Rule 8A of the wealth tax rules. Now wealth tax rules have been abolished, but still the wealth tax acts data, I mean the reference has been drawn into Income Tax Act, so that is still applicable. Whenever I say merchant banker, it is not any merchant banker. You'll have to make sure that it is in category. He is a category 1 merchant banker, where certain capital limits are being prescribed by the law. So that again has to be kept in mind when you are getting a merchant banker's report. Now, valuation date means the date on which the property or consideration, as the case may be, is received by the assessee. What date I'll have to value? I'll have to value as on the date the property has been transferred. If it has been transferred on 5th of August, you'll have to get the valuation report as on 5th of August. Now, there are some practical difficulties when it comes to shares and securities. One, while valuing shares of company A, where it owns shares of company B, and it owns shares, company B owns the shares of company C, then what we'll have to, again, company C again owns some immutable properties. A company owns shares of company B, B company owns the shares of company C, and C company owns immovable properties. Then for valuing company A, you'll have to get the balance sheet of company B and company C also. Along with that, first you'll have to start with the immovable property. Go on and find out the value of the immovable property, bring it into the books of company C, value the NAV of company C, that you will take it, and company B will have an investment in, as part of its NAV calculation. There will be a part where investment needs to be calculated, investment value needs to be calculated. You find out total number of shares of company C, and you divide it by the total number of shares, and number of shares it is B company holds on company C. You'll have to calculate, multiply it, and find out the investment value of company C, company B. From the NAV, using this, you calculate the NAV of company B, divided by the number of shares that company B has, and then go on to company A's investment. How many shares that company A has invested in company B, you find out, and then you calculate the value of company A's investments. Then you find out the net assets value of company A. So this is a very long drawn process. Not much thought has gone into the drafting, but still that is how the law is made up. We'll have to go out with that. What happens if C owns shares of A also? The mechanism prescribed in 11 UA would fail. So A company and B company are there. If they have cross holding, company A owns shares of company B and company B owns shares of company A, there is no remedy under law. Therefore, automatically the entire mechanism would fail. Is it good for us or bad for us? It is good for us, because the methodology is prescribed for the income tax officer to calculate. We calculate it, get it certified from a chartered accountant as a practice, provided to the income tax officer for his convenience. He doesn't, so that he doesn't make a fuss out of it. But in case if the cross holding is there, and if the officer is not able to make a calculation, anyway he's going to drop the case. He's not going to get into the nitty-gritties of it. He's going to stop there. Audited balance sheet on valuation date for every transfer is a tall ask. Particularly when I am going to make a transfer, A and B, two individuals are making a transfer, and the company is, say, Tata Motors. If it is Tata Motors, it's not a problem. Let us say a Tata entity, which is a private entity, Tata Sons, let us say, which is a private entity. For whatever reason, for whichever manner, I have some 100 shares of Tata Sons, which is not a listed entity, it is a private entity. If I hold the share, how would I be able to get the audited balance sheet as on the valuation date? That becomes a very tough thing, but then that is how the language has been prescribed. Now, investment in foreign subsidiaries, again, that's a bigger problem, because this does not cover how to do a valuation of foreign subsidiaries, number one. Number two, if the company holds land in a foreign nation, or if the foreign nation company in which I hold shares holds some lands in that particular area, how would I go on to calculate the stamp duty value? Because it's not applicable in that foreign country. Again, so foreign subsidiaries, foreign assets is a problem where you will not be able to help. Now, in 11 UA, there is an amendment on 25th of September 2023. If we will quickly take a few questions. After the questions, probably we'll go into detail on 11 UA sub rule 2, the 25th September 2023. amendment. So there are a few raised hands. We'll go with that, and then from there we'll move forward. Questions. I think I have some questions here, sir.
Yeah.
Income
So
tax.
Mr. Nitin Kumar can ask for question, please.
Yeah, go ahead.
Mr. Rajiv Dhingra also can ask a question.
Have you allowed them to talk?
Yes, I've allowed them to talk. Yeah.
Okay.
Rajiv ji, you can talk, please. You can ask a question.
Okay, Mr. Rajesh Dhingra sir, he has asked some questions. Number one, income tax states valuer as valuer under registered under the Wealth Tax Act. Can a CA do the valuation at places other than MB1? How about RVSFA? Okay, I am making an understanding out of this question. Number one, Income Tax Act states that yes, you'll have to go on to do the valuation, get the valuation done from a registered valuer under Wealth Tax Act. Correct. Now also you are allowed to go and take a Wealth Tax Act registration. You can take a registration. Number one. Number two, CA can CA do the valuation in places other than MB1? Merchant banker, when it comes to Rule 11UA1, where it is allowed for a chartered accountant to sign, you can either a merchant banker's report can be taken or a chartered accountant's report can be taken in the case of unquoted non-equity, non-quoted non-equity shares. So CCPS, etc. of a non-quoted entity, you can, as a chartered accountant also, you can go on to do a valuation under DCF itself. So that is allowed. But when it comes to Rule 11UA Subrule 2, it's not allowed. Rule 11UA Subrule 2, only a merchant banker can do the valuation for now. Apart from that, how about RVSFA? SFA valuation would be restricted only for land and building, predominantly for values for acquisition of assets before 2001. We take the report again. This is a non-binding report that can be taken and provided to the assessing officer when he comes for scrutiny. Therefore, he satisfies himself looking at the report. He has some document to refer on and pass the order. In case if he is not accepting the report, then he can very well throw the report out. He'll keep it in his records and he'll say, I do not accept it, refer it to the valuation officer. So that is one. The same way, in the case of NAV calculation under Rule 11UA1 or Rule 11UA2, sorry, I have a lesion, so my speaking is a little impaired. So in the case of 11UA1 or 11UA2, when you have the NAV calculation, which is done by a chartered accountant, still, if the office, it's a non-binding report given by the chartered accountant, he will take it on record. But in case if he feels that he has to make corrections to the report and take it on record, he will definitely make the corrections and he will go on to do the assessment. He will go on to pass the assessment on. 11UA states audited balance sheet. Yes, it states audited balance sheet. Registered valuer under wealth tax is allowed to do similar valuation to merchant banker by using cash flow. No. See, registered valuer under Wealth Tax Act, you can use whatever methodology which is prescribed as an internationally accepted methodology, but you restrict yourself only to cases of jewelry, works of art, and the matters similar to that. When it comes to shares and security only, DCF has been very specifically prescribed under Income Tax Act. So when it comes to chartered accountant or merchant banker, they will do the valuation only under DCF because that is what income tax has prescribed. But when it comes to registered valuer under Wealth Tax Act, you have the liberty to choose the methodology approach as well as methodology to do the valuation. You don't have to restrict yourself to DCF only. Any other questions? Meanwhile, let me try to open up. Yeah, go ahead, sir. Any questions? Please go ahead.
They can raise their hands if they want to ask a question, please.
Yeah, a couple of hands have been raised. I'm not sure. If you are not able to, unmute yourself, please raise it on the chat box. I'll take a look at it and I'll respond.
Mr. Yatin Shah, I have activated you. You can ask a question, please.
Sir, I'm audible.
Yeah, you're audible, sir. Please go ahead.
The question is, the chartered accountant who is already registered under Wealth Tax Act and is a registered valuer on their panel, the department is regularly giving assignment to do independent appraisal for 11 UA using cash flow method also. So my question is whether for independent customer also he can use, he can issue the certificate, or only the merchant banker will issue?
Is it equity or non-equity shares?
Equity, unquoted equity.
Okay. Is it for 7B or clause 10? Is it for issue of shares or transfer of shares?
Issue of shares.
Issue of shares, usually report can be given only by a merchant banker. Issue of shares, there is no earlier chartered accountants used to sign off on those reports. Now it has been stopped. Only a registered valuer, only a merchant banker can give, category 1 merchant banker can give a DCF based valuation.
But department,
department, if it is coming, it is fine. That is a department's. So essentially, the assessing officer, he will make his own calculations. So when
no. The point is, department is assigning this work to the chartered accountant to do to appraise the existing valuation report issued by merchant banker, which has used cash flow technique.
This is a review function. That is a review function where the departmental assessing officer, he wants to verify whether that particular valuation done by the merchant banker holds good or not. Therefore, it is his prerogative to give that kind of assignment. That kind of assignments can be accepted and it can be done. But even a chartered accountant can do a valuation and give. Only thing is, it is not binding on the assessing officer.
Okay. Thank you, sir.
Yeah, sure. Okay, quickly, let me take you through the new amendment that has come in the current 23rd September 2023. Let me give you the correct date. I think it's 23rd September 2023. They have come out with a 25th September 2023. The CBDT has come out with a new 11 UA sub rule 2, where the amendment has been made in the calculation of the valuation of unquoted equity shares. They are allowing now not only DCF, they are allowing comparable company multiple method, they are allowing probability weighted expected return method, they are allowing option pricing method, milestone analysis method, and replacement cost method. Again, these 5 methods can be done only by a merchant banker. It cannot be done by a chartered accountant. The chartered accountant thing will come here, where the fair market value of unquoted equity shares determined by a merchant banker. That is one of the methods. B. Apart from that, they have come down to 5 other methods that has been prescribed specifically for merchant bankers to do the valuation, because merchant bankers were finding it very difficult. One thing that I was wondering is, now that the registered valuer profession has been created by the government to do the specific for the specific purpose of valuation, why is a merchant banker and is the person again and again who's being used for the purpose of valuation under other acts is something that evades my thought process. Probably representation from multiple RVOs needs to go to take up this issue, where the chartered accountants and merchant bankers, wherever they are doing valuation, needs to come to the registered valuers who are being trained only to do valuation. Merchant bankers, they are supposed to do a lot of business, but valuation is something that is not their core area. That's my individual personal thought, not that of the RVO, but I would urge the RVO members to consider it. Any other questions?
I think this is it, sir.
So let me quickly share the slide. One more thing. So I will end this session with a simple quote: try not to become a man of success, but rather try to become a man of value. So the quote says that you'll have to become a person of values. As a registered valuer society, we try to make value from the existing, by creating value to all the transactions that are happening. So I don't know whether this session is a grand success or not, but I hope some value has come to you. If I'm able to add 1 point value, I'm very happy that I've done it. This is my contact details. In case if you have any doubts, you can reach out to me. I'm sharing the presentation to the team, so we'll share it across you too. Thank you so much. Have a wonderful evening.
Thank you, CA Santosh, for this session, and thank you all the members. We will be issuing you the certificate on Monday. Thank you, everyone. We'll end the session now.
Thank you. Bye.
Thank you.